I don't know where to start with this video. I contemplate sometimes if I should even do a video on this because it's not exciting stuff to talk about. Um, but I think it is important for people to know, and it is important to understand, when we do look at markets and when we look at key players and key movers in the markets, one of them being the central bank. So today we're going to talk about Bank of Canada. We're going to talk about Canada Central Bank and what they came out today and what they have spoke about today about the inflation, interest rates, and which also translates into the Canadian housing market and the Canadian real estate market as well. So I'm going to also post an article from the Globe and Mail. Basically, the title from the article is Bank of Canada warns high household debt and elevated home prices pose top risks to the economy. So I'm going to post that for you to read a little bit more about it. But before I go into there, I want to talk about a couple of comments that I got from my Reuters feed. So I'm subscribed to Reuters. So I'm just going to comment and talk about some of these things here. So first things first, Bank of Canada, they came out around 10 a.m. and then later Macklem came out also and spoke about a couple of things about the market. So first thing at 10 a.m., Bank of Canada, this is what they said. Bank of Canada scenario says some Canadians who took out mortgages in 2020 and 2021 could see monthly payments jump by 45% in 2025 and 2026 as rates rise, right? So, okay, that's not sounding so good coming out from the central bank themselves, right? We're not talking about any advisors there, and please note that this is not financial advice. I'm not telling you what to do with your property or with your investments or finance or anything like that. I'm not an investment advisor. But what I do want to mention is that this is coming straight from the bank itself, from the Canadian bank, the Bank of Canada, saying that they could see payments, monthly payments, rise about 45% for a lot of Canadians who took out these mortgages and these loans back in 2020, 2021, right? Because what happened during that time, right? People were shocked that real estate prices rose during a pandemic and during a crash that we saw in 2020. Real estate prices rose all of a sudden, and it had to do with the amount of money printing and the amount of money that went and flocked into the system, and the cheaper rates too, right? We got a lot of cheaper rates that came in, and basically that also brought up housing prices higher because you could borrow much more at a cheaper rate, and which makes money very cheap, borrowing very cheap, which then translates to cheap money flocking into assets like real estate to take advantage of the gain. And that's why we saw a lot of these prices move up. One of the main reasons, much more also, but one of the main reasons is because of that. So coming out from the Bank of Canada mentioning about these high payments is worrisome for people who took out a lot of debt and who went over leverage, right? If you're not over levered, or if your situation is fine, then you'll be better off than definitely the ones who over levered, or basically are in much more of a tougher situation because they got greedy during that time, and many of them probably haven't already sold yet. So going through these comments here, just want to mention Bank of Canada tightening of monetary policy globally will test resilience of financial system and could worsen existing financial vulnerabilities, right? So this is a global coordination that's happening among not just in Canada itself, but around the world also when it comes to tightening policies, right? The ECB also came out today. We have the Federal Reserve coming out next week, and it's all about tightening markets to bring down and fight this inflation, right? Bank of Canada vulnerabilities associated with elevated household indebtedness and high house prices increase the downside risk to future GDP growth, right? So obviously, when you're increasing rates, you're going to see growth come down, GDP numbers come down. I did a video also just yesterday on the what was it? The World Bank talking about growth and GDP coming down lower. So same thing, right? A lot of these countries, especially like Canada, is expected to see growth come down quite a bit. And then here's another comment from Bank of Canada. Those who entered the housing market over last year would be more exposed in event of a significant price correction, right? So they're already coming out and they're laying the possibilities, right? They're coming out and they're saying that, those who borrowed last year, the likelihood of, if we do get into a correction, which I think we are really heading towards, especially after reading this, again, it's not financial advice, but what is Bank of Canada saying? That those who have borrowed, especially beyond their means, is definitely in much more of a risk of being affected by a downturn in the markets. And then we have Bank of Canada saying it's too early to tell whether recent decrease in housing resale activity and prices will be temporary or the beginning of a substantial correction, right? So they're coming out and they're saying, okay, and mainly because of they want to see more data when it comes to inflation, right? Now, let's spin this a little bit in a positive direction here. If inflation comes out lower and the data comes out lower and lower, then there's no need to be very, very aggressive with the rate hikes. Then sure, things maybe curb a little bit, because now there's evidence that is showing that the current tightening, the current monetary policy, the current rate hikes that's happening, the balance sheet runoff, we're seeing prices start to come down. So sure, that could be a possibility, but just like with other banks out there, they are data dependent. They want to see what is coming out from the central banks, and when it coming out, the data that is coming out from a weekly, monthly basis, in terms of inflation and growth. So definitely that is still something that we need to watch out for, which again could make things better in terms of its aggressive tightening, right? Going down again here, just reading through these notes. Bank of Canada, so it says that vulnerability associated with elevated house prices increased further over the past year. Evidence implies overall proportion of highly indebted households likely surpassed in pre-pandemic peak in 2021. Bank of Canada says financial system vulnerabilities have become more complex and risks have become more elevated. Bank of Canada says it's paying particular attention to the fact that the greater number of Canadian households are carrying high levels of mortgage debt. So, okay, that's a not bad comment, saying that the Bank of Canada is watching the level of high debt that households hold, and definitely they don't want to kill off the economy. For sure, they want to bring down prices and bring down inflation, but they're watching the debt levels and making sure that, hopefully, hopefully, that things don't exacerbate and try not to create maybe a 2008 kind of sell-off or a situation in the economy, right? So that was one, I would say, positive point that came out from Bank of Canada. Let's read through this a little bit more. Okay, let me go on to another one. Bank of Canada risks further disorderly repricing of risk remains, which could lead to much tighter financial conditions globally and in Canada. New outbreaks of COVID-19, lockdowns, and blah, blah, blah. Okay, not really important here. Fixed income markets remain ongoing. Risk of a quick repricing of assets exposed to climate change. Da, 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 da. Let me just read this a little bit further here. Markets participants' confidence in resilience in Canadian financial system has hit highest level reported. tightening monetary policy globally will test resilience. Okay, we heard that already. And yeah, so same comments that we've been hearing. I'm gonna now. Okay, after an hour, I'm just gonna show you here. After an hour later, we had Macklem come out, right? So Bank of Canada. This is the head of Bank of Canada, and I wanna mention key comments that Macklem said. So I'm just trying to scroll and find it here. So it is, sorry, I should have prepared a little bit earlier than what I'm doing right now. Please don't mind. You can play some music in the meantime while I try to find this. Okay, here it is. So, BOC's Governor Macklem. The Canadian economy is overheating. It needs higher rates. Macklem again. Whether consumers could absorb a rate hike of more than 50 basis points, we would need to take a larger step. Okay. And then again, more forcefully means more or bigger rate hikes. So that just blows my mind. Okay. Coming out and saying that more forcefully means more or bigger rate hikes, more than what, 50 basis points? Could you do a 75 basis points? That's a possibility. So that's pretty hawkish statements that came out from Bank of Canada. And if there is one way, if I asked you, tell me one way, actually show me how the economy is going to be affected or may go in a recession without telling me that the economy is going to go in a recession. If I were to ask you, show me how that would play out, you'd probably say and point towards these comments that Macklem said, that the that the Bank of Canada Macklem came out and basically said these really hawkish comments today. And it would be literally this: the Canadian economy is overheating. It needs higher rates. Coming out, it needs higher rates. It needs higher rates. Okay, we know that you are going and you're going to continue with higher rates. But saying more forcefully, or we may need to take a larger step, or more forcefully means more or bigger rate hikes is definitely very alarming. So as soon as I heard that, it was, to me, a no-brainer, which tells us that they're prepping the markets, and people are not listening because they're busy during the day, they're working and whatnot, and that's okay. That's why we cover all this. That's why we try to help you out in digesting this information and what it means. So, when you look at all of this, people are not realizing. They're just listening to maybe their realtors telling them that yes, buy properties, buy properties, buy properties. When on the other hand, you have the biggest bank in Canada, Bank of Canada, and the head coming out that we may have to act more forcefully. We may have to act more aggressively when it comes to rate hikes. And maybe that may mean more rate hikes, right? What does that mean? That could mean more 50 basis point rate hikes. That's pretty hawkish. That's not positive for the market. That could also mean that maybe a 75 basis point rate hike, which is even more aggressive. And I think the answer to that will come when we see inflation is not coming down. If we're able to see that inflation is not coming down, then yes, you can definitely bet. You can definitely bet they are going to be aggressive. They are going to raise rates. So your clue in finding if whether they're going to be aggressive or not, whether they're going to forcefully cause demand to just shrink like no tomorrow and cause possibly or even a recession, is watch inflation. If inflation continues to be elevated and it's not peaking, especially if it's not peaking, I don't know what to tell you. I really don't. And it's not, it doesn't sound rosy. It just doesn't sound rosy to me that you have the head of the Bank of Canada saying this. And again, people will ignore the news, people will ignore the noise, they'll listen to the realtors out there and they'll say, oh, just keep buying, don't worry. I'm not saying that what the realtors are doing are basically, they were wrong in the past 10 years. They were right actually in the past 10 years that real estate prices did go up. But could this be the time or the event? Could this be the era where we see real estate prices really drop heavily? Definitely, I could see the stock market coming down quite heavily, stocks and asset prices coming down. But when you take a look at real estate tends to be a hedge against inflation, and that's why people buy real estate. Now, during a recession or environment where inflation continues to be elevated, will we see real estate drop off aggressively, since it is supposed to be a hedge against inflation, right? Inflation is up there, buy real estate, buy these assets. But if you have something that is really detrimental to the economy and that's really going to cause panic selling in the market, then we could see a reverse course in these prices, which then might present an opportunity for buying opportunities to get very discounted prices, especially on homes, for the next leg run up and for Bank of Canada to then again step back in and stimulate the economy. But in terms of this year and the next year, you know, tensions continue to rise, oil prices continue to rise, inflation is still elevated, right? We'll have to really monitor on this inflation fiasco from a data to data point of view, and most importantly, don't reject the news that is coming from the central banks. They're very important. And ECB also came out today and projected inflation this year to be a little bit higher than what they projected before. And we have Federal Reserve coming out next week. They're going to come out with their projections also. We'll hear about their inflation expectations, their interest rate expectation, their growth expectation. It'll be very interesting to see if they revise it and change it. If they show that inflation's higher, growth lower, and especially the jobs component too, unemployment, they kept that the same. Are we going to see higher unemployment if you're projecting lower growth, projecting higher inflation, and then higher rates, which then should or eventually bring inflation lower? Why is the jobs component still not moving, right? So, you know, their argument is that the Fed, when they came out, the U.S. central bank, when they came out, their argument was basically saying that the economy can handle it. I don't know if you want to agree with that. I don't know if you buy it. To me, personally, I don't buy it. But personally, I think something is definitely not looking good for the coming months. So, anyways, we'll continue to monitor this. We'll continue to monitor the data, the central banks, and all of that. And if you have any questions or you have any comments on what you think is going to happen with the Bank of Canada and where they're going to go with their rate hike cycle, feel free to leave your comment below. And I'll see you guys in the next video. Good luck, and I'll see you guys. Bye.